The first section we're going to cover is the purpose of inventory accounting. Okay, so the purpose of inventory accounting is to keep accurate inventory cost records. And this is very, very important. The reason that it's so important is because it helps us get a good picture of our profit, our profitability. So when we receive amounts from customers for the goods that we sold them, we're going to call that sales revenue. Now we subtract from sales revenue the cost of those items, the cost that we paid to our suppliers. We call that cost of goods sold. And when you subtract cost of goods sold from sales revenue, you get gross margin. Hopefully we made a good gross margin. The important thing is we have to keep accurate track of the costs, because if we don't, the gross margin will be wrong. And if the gross margin is inaccurate, chances are we're going to be keeping items on the shelf that really aren't helping the company to earn a profit, and we'll also be missing out on opportunities to invest in other inventory items that actually would be helping the company out. So this cost piece is very, very important. Now, keeping accurate inventory cost records basically means two main things, and we're going to look at these separately throughout the course. The first is that we have to keep track of the cost of inventory items purchased from suppliers, so as the items come in the door. Secondly, we need to keep track of the cost of inventory items as they are sold to customers. So if we look at the diagram at the bottom, we purchase the items, we hold them for some period of time, even if it's just a few hours, and then we sell them. And there's actually a separate accounting process, if you will, as we account for the cost of those items as they go out the door, as opposed to the cost when they're coming in the door.